Oh my stock price has collapsed. What should I do? Hello everybody, this is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, a.k.a. Mr. Valuation. Just a couple of points before I get into this video. Number one is they call me Mr. Valuation because I'm a value investor. And as a value investor, I invest for the long run. But I want to talk about investing in general with you a little bit. First of all, I've been doing this for 50 years, and I certainly do not have a perfect track record. Investing is not about being perfect. I've never known or, come across any investor ever that had a perfect record. That's, for goodness sake, that's why we diversify a portfolio, because mistakes are going to be made. Sometimes they're obvious, and sometimes they're simply unavoidable. But one of the things that I believe in, we should try to avoid making the avoidable mistakes as often as we can. In other words, don't make obvious mistakes. If you make a mistake, earn it. All right, so what we're going to talk about today is what I've been asked. This is actually part 10 of my 11-part series on sectors. And in part 10, I've been covering REITs. But there's one REIT that I've written about or videoed about several times. It's called MPW. And I've been asked about that quite often. So let's get right into it and talk about MPW. The stock fell 29 to 30% just 2 days ago. By the way, it's up about 7% today. The real question is, what should I do when the price collapses? So what I want to do is I want to look at MPW, and we're going to do quite a bit of research on that. But I want to put some perspective on here first. This is a healthcare REIT, okay? And they own hospitals. A couple of other retail REITs that went through a similar situation in the past was, number one, the first one I'm going to look at is Tanger. All right, and if you're not familiar with Tanger, you can go in FastGraphs, go into the company's corporate website, and learn that, Tanger is a mall REIT, okay? And mostly they have outdoor malls. And so you can see some of the locations here on the picture. And as a mall REIT during COVID, when COVID hit, they got in a lot of trouble. But prior to COVID, I want to make it clear, COVID was a catalyst that actually created this drop in price. But otherwise, Tanger was going through some operating issues. Their funds from operations were dropping. The market had been pricing them at a high value. And Tanger, from its peak valuation, fell, from peak to trough, basically, or as close as I can get to it. It fell 89, almost 90% in value from July. But I also want to point the stock was overvalued. Now, from it being undervalued in, let's say, December of 2017, it fell 83% in value in just a couple of years. Now, here's the point. Fundamentals were dropping. The stock price dramatically overreacted to that. And then at the very bottom, look how quickly and how dynamically the stock price reacted from April of 2020 through January of 2024, this current year. We're looking at a stock that increased 384%. It almost quadrupled over that point in time. Now, I also wanted to show this because I also want you to notice that they covered their dividend and started paying a dividend again. So if I look at this stock and look at it from, let's say, a 5-year perspective, that's about where we were, and I look at performance during the time when they were in trouble, it actually outperformed the stock market by orders of magnitude, as measured by the S&P 500. But the only way it did that was by collapsing in the first place and becoming so ridiculously undervalued where it was selling at approximately 2 times FFO. Okay, the moral of the lesson is stock prices lie. It's much better, in my opinion, to focus on the fundamentals. Now, the fundamentals here were weakening, but I want you to notice the company stayed, I'm going to say profitable, because in a REIT, you measure it by funds from operations. And funds from operations stayed positive, okay, even during all that price collapse. The dividend was cut, all right? So, that was a problem, but they reinstated the dividend, and then the dividend has grown again. The next stock I want to look at is Simon Property Group. Now, this is an A- rated REIT. And once again, you see a stock or a REIT that had pretty good performance, but they did hit some weak performance during COVID. And they also cut their dividend during COVID. That was their, nemesis, if you will. COVID is what hit Simon Property Group. when I put the weekly closing stock prices on the graph, once again, we see that the stock price fell precipitously. We had a 69, 70% drop in value from May of 2019 to April of 2020. That's approximately 1 year's time. That's going to be very similar to what's going on with MPW. Now, the business recovered, and then, of course, so did the stock price. It recovered dramatically as well. All right, and we ended up with a 98% annualized rate of return over the next 2 years. The point is, as a value investor, first of all, you've got to be a long-term investor. Okay, you've got to be investing for the long run. Now, I started writing about this stock when it was trading somewhere around here. I'd have to go back and look exactly. But we've obviously had this precipitous drop. It fell from being what appeared to be fairly valued based on some pretty good estimates here. And it fell about 85, 89% since January of 2022. So in the last 2 years, the stock is down dramatically. Okay, but again, if we take stock price off the graph and just look at the company from a standpoint of the business, we do see weakness. They clearly have a problem. There's no question they've had a problem with Steward, and Steward, which is one of their major tenants, Steward represents a substantial amount of their revenue, roughly 23%. But they have not lost Steward's revenue. They are deferring it right now, and they are partially collecting it. Okay, so, the company still expects to have positive FFO for the next 2 or 3 years, but the analysts do expect some weakness. Okay, so the point is, when I look at this company from a standpoint of their business, they still are a viable business. They still are financially, profitable, and they still are healthy. They did cut their dividend in half, as we saw with Simon and Tanger before, and the stock is obviously down. Now, going into forecasting, this is very important because since the announcement where the stock fell 29% the day before yesterday, the analysts have changed their estimates, okay? So for 2023, which is fiscal year ended, about a week ago, and they won't report that for, I think February 1st is when they're going to make their report, if I'm not mistaken. Analysts were expecting $1.55 and then $1.57, and then they came in at $1.57. But here's what's interesting. For next year, this upcoming year, which we're right in the beginning of this upcoming year, analysts were expecting $1.48 3 months ago and $1.59 6 months ago. And their most recent estimate was $1.37, which is what we're currently seeing. For 2025, the estimate fell from $1.53 6 months ago to $1.05 to $1.36, where it currently is. And then it also, for 2026, it fell from $1.50 to $1.33. These are, not great numbers, but they're still positive numbers. That's assuming that, they don't recover from Steward. Okay, but we're not thinking as long-term investors here. Number one is, as an investor, I want to make a couple of points. I first recommended this stock as an income vehicle to turbocharge a dividend portfolio. In other words, I recommended it as part of a well-diversified dividend portfolio where you could get some higher income. Now, they did cut their dividend, but even after they cut their dividend, they still offered higher yield than most stocks do. And I've added to it, and I'm probably going to be adding again here, although I'm still evaluating that. But right now, if you ask me my opinion, I'd be buying more MPW, and I plan on buying more MPW, is my instinct, because I do believe the company is going to survive, and they are going to work through this. Okay, now, there are reasons for that, which we'll get into here in a moment. But the point I want to make is I do not see this as a dead business. I see this as a business that's going through some weakness, just as I saw a company like Tanger going through weakness, and just like I saw a company like Simon Property Group go through weakness, and just like I saw the prices, collapsing and accordingly, but yet these turned out to be the best times in the world to buy these stocks. Like, for example, if you just look at Tanger, which I think is the one that really had, several years of more severe drops in FFO than we're currently experiencing with MPW. If you'd have bought it when it looked cheap, prior to it, that was a price at 11, and prior to it falling down to a price of 4 something, okay, and trading at a PE or a price to FFO of 2, and you bought the stock then, okay, at this time frame when the PE was in the 4 range, and held it to yesterday's close, you would have tripled your money over this next 3 or 4 year period of time. And you would have also received a significant amount of dividend income over that short time frame relative to your investment. Now, that's not buying it at the perfect bottom. If you bought it even higher up here when, the price to FFO was 7 and walked through all this drop and held it till yesterday's close, you'd have made annualized 16.43% per year. If you're a long-term investor, the best time to buy stocks is when they're in the dumps like this, as long as the business does not totally collapse. What you don't want to do, and I'm going to go throw it in here, you don't want to invest in a stock like Pitney Bowes, for example, that literally became a dinosaur, and you saw, operating results just continuing to collapse along with the price continuing to collapse. That's not what I'm talking about. I'm talking about a company here that is going through weakness, but is expected to, continue to stay in business, recover, and even solve their problems. So if you're a long-term investor investing for income and looking for, a long-term future opportunity, then now would be the time that you would want to be buying the stock. And, you can look at, recent news on the stock. For example, here's the website Seeking Alpha, all right, which you can get a link to if you're a FastGraph subscriber. And if I query MPW and look at recent articles on MPW, the most recent articles today talked about calling it a hold. And they talked about a cautionary tale, time to worry about the dividend. And it is possible the dividend again could be cut. But yesterday, during the throw, or, on January 7th, during the throw of the big drop in price, Medical Trust has likely bottomed out. Time to be greedy and load up. Medical Trust, the nightmare scenario, still offers strong upside. Okay, and so, the point is, today it's up 7.37%. The stock has actually looked like it might be starting to recover. Now, if I go into other websites that follow the stock, for example, if I go from FastGraph's page and go in Zacks Investment Research, they value it as an A. They call F for growth because it's obviously had no growth, D for momentum because it's obviously had lousy momentum, but they give it a C score. So an A, an F, and a D averages out to a C, and they call it a hold, okay? And if you look at, other sites and other pieces of research, you will find that, the company still looks like it's, going to stay in business. And again, I want to remind you, in the third quarter of last year, Stewart accounted for $70.7 million, or roughly 23% of Medical Property Trust total revenue of $306.58 million. All right, so, they still look attractive on a scale of they're still generating revenue. The stock does not look like it's going out of business now. Now, is it a great situation? Obviously not. Nobody wants to see their stock price go through this kind of thing. But where others are seeing nothing but risk and dire straits, I see a lot of opportunity being created here because I still consider it a very strong income producer. And from here, I think the income level will be good, but it's possible it won't. And if they cut the dividend again, I reserve the right. I think it was John Maynard Keynes who said, when the facts change, he changes his mind. What do you do, sir? I'm not sure who said that now, but that's, that to me is a reality. You follow the facts and you follow the data. All right. And, if you follow that, then, MPW is not going out of business here, contrary to what a lot of people might be thinking. MPW is going through a lot of stress right now, though. There's no question about that. And I think that's a reality. But the question is, are their problems solvable or not? There was one Seeking Alpha article I'd like to mention here, bring your attention to. The article was titled Medical Properties Trust has likely bottomed out by Morrell, a Seeking Alpha author. And he did talk about a couple of things in here that I found interesting. One is he talked about false claims. There's a lot of rumors. There's a lot of short sellers out there. Everybody's talking about how lousy the management is. And yet this company has just recently been recognized as a company that has been of high integrity. In a recent, you can find that out by looking up getting on their website. But they pointed out false claims. They always overpay for real estate. Turned out not to be true. MPT engages in round tripping of rents, and they pointed out it's simply not even possible to do that. And then tenants are in a weak financial position, unable to continue paying rents. That is true with Steward, but there are other tenants that are basically going to be still paying their rents, and this company will still be in business, and their real estate properties are strong. Now, they did put out a notification, a letter, explaining what they were doing. And again, go into the website and go ahead and go into the section on news and look for Steward. And then Medical Trust did give their upgrade. All right. They provided an update on the Steward healthcare, and they talked about what the things that they're doing to fix them. And then they put this table in here, which showed what I alluded to earlier, what, roughly about 23% of their business was related to Steward, but the other 75% is doing quite well. I also want to go into here and look for press releases if I can. For example, here's the press release that they uploaded recently on December 6, 2023. They were named by Newsweek as one of America's most responsible companies. In other words, I'm not trying to sing all the laurels of Medical Properties Trust. The company has gone through some really tough issues here and is going through some really tough issues. But I believe all their problems are solvable, and I think the stock is a giveaway. You can buy this stock at a blended priced FFO of 2. It has a earnings yield or FFO yield of almost 46%. Those are fabulous numbers. So, the opportunity here, if this stock were to go back to normal valuations, and I'm going to use the normal multiple here of a 12 FFO, which is quite reasonable for this company, you'd be looking at making 76% a year from these levels. By the end of next year, you could actually be quadrupling or almost increasing your position by 5-fold. And if you went out to next year, about 5-fold as well. So the point is, in all the risk out here, there's the old saying that risk and opportunity are two sides of the same coin. Where there's great risk, there's also great opportunity. And I think Medical Properties Trust does operate that. But I want to end this by saying this key thing. I did not buy this stock to sell. I'm going to be probably adding to it. I intend to own it for many, many years to come. And the only reason I will change is if I do see this company under an imminent collapse. As the great investor Marty Whitman said, we must make a distinction between a permanent impairment of capital and the temporary interruption in a good business. I think this company, as a healthcare REIT, hospital owner, is in a real good position to survive over the long run. And buying the stock at these prices has just got to be, a giveaway. So, you do what you want and do what you think is best with your money. For my money, I'm not ready to throw in the towel on Medical Properties Trust yet, because I have not lost any money on this stock because I haven't sold not one share of stock that I bought. I want to make that clear. An unrealized loss is not a loss until you take it. If you sell, and if I sold right here, I would lose a lot of money on this stock, and I have clients that would lose a lot of money on this stock. But if I buy more here and average it down and hold it for the next 2 to 3 years, and it does survive, first of all, that's the big thing. And second of all, it begins to recover. That's the other thing, which I think they're doing everything they can to get there. This could be a phenomenal, speculative, but phenomenal long-term investment. Anyway, this is the update that you all keep asking for. Since I was covering REITs in this, section 10 of my GIC sector, I thought I'd go ahead and bring in, an update for y'all as part B of my part 10 of my 11-part series. Thanks for watching. If you liked the video, give me a like, ring the bell, take a look at subscribing to Fast Graphs, and I'll see you on part 11 next.